everyone. Thanks for coming along today. My name is Anne Dermont. I'm the Executive General Manager of the Morgans Financial Offices here in Milton and also at Ipswich Springfield. So you're here today to get an update on the banking sector from Azib Khan, who's our research analyst on that sector, who's come from Sydney just today and is going home again today. So thank you, Azib, for your time. Azib has worked in the banking and finance sector as a private equity advisor, an actuarial consultant and equity analyst with major companies such as PricewaterhouseCoopers and Wilson HDM. He joined Morgans in 2015 with a focus on Australia's Big Four and regional banks. So before we start, I'd just like to take a minute to tell you about us. So Morgans Financial started in Queensland in 1982 and has grown to be Australia's largest retail stockbroking and wealth management firm with 60 offices across the country. The Milton office opened in 13 and a half years ago under a franchise arrangement. Our business is owned by the management and staff, and we have a total of 15 shareholders out of 30 staff, which includes our Ipswich office and our wholly owned accounting firm, which is Strategic Business and Accounting Solutions, with the office just off the foyer here. So we pride ourselves in delivering excellent financial advice across all areas of investment, superannuation, insurance, and also accounting, tax and business services. Please have your questions ready at the end of the presentation, and we can have some discussion time, and then feel free to stay and have a coffee and a chat to one of our advisors afterwards. So I'll hand over to Azib.
Thank you very much, Anne, and thank you to everyone for coming in. Hopefully you will find this presentation insightful. And most importantly, I suppose, I'm sure, I mean, banking's been a pretty topical part of the share market for some time now, but even more so now that interest rates are getting lower and lower, so I'm sure you've got plenty of questions. As Anne said, look, what I'll try to do is I'll try to restrict my speaking time to 30 or 40 minutes, so we've got enough time for Q&A. But just so everyone's aware, if you do have any questions in between, I'm okay to take them. So don't feel like you'll be interrupting me in any way. If you have any questions, it's only natural for you to ask them in between. So I'm happy to take them. And for me, that's going to be the most important part, just making sure you don't walk away with any unanswered questions. So with that, we'll get started. So banking business as usual. The first slide, throwing a lot of numbers there, I suppose, but what that's basically saying is that's giving our ranking at the moment for the four major banks. And my presentation will focus pretty much around the four majors, but if you have any other questions around banking, please do let me know towards the end. So at the moment, look, I think it's fair to say we've got overall a positive stance on the major bank sector. And as you can see there, we've got 2 ad recommendations and 2 hold recommendations out of the 4 major banks. So Westpac is very much our preferred major bank at this point in time. And we're liking that both on company fundamentals and a valuation basis, and we'll talk more about that as the presentation progresses. ANZ's our second preferred, and the NAB and CBA are our least preferred. But as you can see from that, we've got 2 ad recommendations, 2 holds, and overall it is a positive stance. I suppose the most attractive feature right now being offered by bank stocks is the dividend yield that's being offered. The dividend yields on offer at the moment are somewhere between 5.3 and 6.9% fully franked. And these dividend yields are starting to look increasingly attractive as interest rates get lower and lower. Now, a natural question to ask is, well, a lower interest rate environment generally stems from a weaker macro outlook. And a weaker macro outlook might mean asset quality deterioration and lower revenue and earnings growth for the banks. So can these dividend yields be sustained? And that's something we'll explore. I mean, to give you the summary of that, I think the dividend yields that are being offered are largely sustainable. And I think that's what creates some of the valuation upside in the banks, and we'll discuss that more. Is there a question there? I was thinking maybe you had a question. Okay. All right. So just to just to quickly summarise it, and then the following slides will go through it in more detail. But from a macro point of view, we are in a lower interest rate environment. It is making the div yields look more attractive. We've already seen the hunt for yield begin. It started a few months ago when the US Fed started going dovish and the RBA started going into a dovish mode. We've already seen that hunt for yield take place in the REIT space, in the utility space. So we've seen enough yield compression in that part of the market. So really, it's the defensive yield plays have already benefited from the yield compression, but some of the more cyclical yield plays like the banks are yet to see the benefit of that. In terms of company fundamentals, so just putting aside macro for a bit and just thinking about the earnings outlook for the banks, it's my view that the banks on an underlying basis can deliver mid-single digit underlying earnings growth. And I don't think they're quite being priced for that. I think there's enough bears on the street from a bank's perspective, and they're thinking that the banks will struggle to get any earnings growth. Whereas my view is I think the banks can do mid-single digit underlying EPS growth. And that together with their sustainable dividend yield should be supportive of share prices. And in terms of that mid-single digit underlying EPS growth, just to quickly round it off, the banks won't be shooting the lights out in terms of revenue growth. So I am expecting revenue growth to be quite subdued, low single digits. But that together with a focus on cost reduction, and that's going to be one of the more exciting themes out of the banking sector over the next 3 to 5 years. A focus on absolute cost reduction, and I think that together with even low revenue growth can allow the banks to quite comfortably deliver mid-single digit earnings growth. And as the presentation progresses, we'll also talk about asset quality. Obviously, the banks are in the business of credit risk. That's something that they take as a natural part of their business, and it's important to understand that risk profile and how bad debt charges might or might not blow out in the foreseeable future. And obviously, I'll also be talking about the capital and dividend positions, just to talk about the sustainability around those dividend yields. So with the macro, so as I said before, we're in a lower interest rate environment now, not just in Australia, but also in the US, also in Europe. It's fair to say broadly in the developed world. And over the last 12 months, you would have seen a lot of headlines, a lot of media articles about the trade wars between the US and China. I think very quickly those headlines will switch from being about trade wars to currency wars, because now we're going in a phase where every country is trying to lower or weaken their currency just to allow themselves to export their way and reflate their economy through a weaker currency. And so as a result, what we've seen is that, last calendar year we saw the US Federal Reserve, which is the US Central Bank, they were tightening rates, right? And so they'd ended their QE program, they'd started shrinking their balance sheet, and they were actually tightening rates as an increase in their Fed funds rate. And as a result of that, what we saw last calendar year is the grey line here is showing the US 10-year bond yield, and what we saw last calendar year is a pretty sharp increase in this grey line, and it went all the way up to around 3.25%. And what that was doing was that in itself was creating quite a few strains in the global credit markets, because it was draining some of the US dollar liquidity out of the system. And our banks were even feeling the pinch of that last year through an increase in the cost of some forms of their funding, so particularly money market funding and short-term wholesale funding costs. They had blown out last year, and I think that was pretty much solely due to the Fed going through this tightening phase. But then what we've seen as the year turned, a lot of the central banks have turned in terms of their policies. And we've seen the US Federal Reserve now go into a very dovish mode. We've seen the RBA go into a dovish mode. And as the Fed Reserve becomes more dovish, the RBA can afford to become more dovish, because it allows them to cut rates whilst not completely tanking the Aussie dollar. So for the moment, the Aussie dollar is sitting at about 70 US cents. And I think the RBA is pretty happy with that level. If the RBA cuts in the absence of the Fed cutting, then obviously it will drop below 70, and that's not something the RBA wants. If the Fed does cut next week, you can expect the Aussie to possibly pop up over 70, and that gives the RBA a license to cut another 25 or 50 and keep the Aussie at 70 cents. So So we are getting into this currency war situation, and the banks will be looking to become more and more dovish in terms of the central banks. So what we've seen so far this calendar year is a sharp pullback in the US 10-year bond yield, which is the grey line here. And again, it's come back from about 3.25% all the way down to close to 2%. And more importantly for us domestically, what we've seen with the Aussie 10-year bond yield is the RBA has become dovish. That's come a long way from, it was close to 2.75%, and it's now down to about 1.3%. This is the Aussie 10-year bond yield. So we're in a situation now where the 10-year bond yield is yielding 1.3%. You obviously get zero in your transaction deposit account. You're getting about 15 basis points as a base rate on your online savings account, deposit account. Term deposits might be paying you, 1.5 to 2%. So generally, there isn't that much yield around. If you take a look at property, generally, you'll be doing well if you can get a net rental yield of 3%, right? But you've got the banks offering a dividend yield fully franked between 5.3 and 6.9%. So all of a sudden, with these low rates, the banks are starting to look very attractive from a yield perspective. And like I said, we've already seen the REIT sector and the utilities sector benefit from the high yields that they offer. And being defensive yield plays, they've already seen valuation upside from that. I think the banks are logically the next in line to benefit from some of that valuation upside. I suppose that's just a different way to say what I just said, but as an analyst, this is really how I think about it. What we're thinking about is when the share price, in today's share price, what sort of return are investors building in today's share price? So to get to today's share prices, I think investors are generally allowing for a return of somewhere between, let's say on average about 10%. Generally, the bank share prices are priced off a return of somewhere between 9 and 11%. When investors are demanding a return of 11%, the shares are starting to look quite cheap. And when they're happy to take a return of 9%, the shares are starting to look quite expensive. But what's going to happen is, as these risk-free rates, these government bond yields fall lower, investors will be prepared to accept a lower return, right? Because if we just think about the return from a very simplistic construction, what investors look for is a risk-free rate plus a premium in equities, right? Now, even if you keep the premium you want in equities unchanged, the risk-free rate is falling. And as you saw from the slide earlier, it's actually fallen quite considerably even this calendar year. And if the Fed continues to remain dovish and becomes more dovish and they cut, and the RBA cuts further, and it's actually even possible, and I'm happy to discuss this later if you're interested, but it's possible we'll see quantitative easing even here in Australia in a certain form, and that can result in bond yields falling even further and risk-free rates dropping even further. And what that means is that investors are prepared to take, happy to accept a lower return on their bank equity investments. And that can actually drive share prices up. So every 100 basis point or every 1 percentage point reduction in the return that investors are happy to accept generally results in 20% valuation upside or share price upside, right? And that is the potential upside here that we're looking at for the banks. I'm now going to just talk about some of the thematics. So that's the macro, and I'm happy to talk about more macro question time if you like. But just to move on to some of the thematics and what's really impacting the bank sector more specifically. So I suppose it makes sense to start off with the Royal Commission. It's now, for many, it feels like it was a while ago now. A lot has happened since the Royal Commission ended. But for many of you, you're probably wondering, what is happening in the aftermath of the Royal Commission, what are the implications? So quite frankly, from a core banking perspective, and when I say core banking, if we exclude, so banks have been involved with wealth management, life insurance, financial planning, and other kind of non-core banking activities. But if I just talk about core banking activities, which is basically retail banking, business banking, institutional banking, there hasn't been too much impact. Now, we have seen impact on the retail banking front, and yes, it has been significant in some respects, but not as much as what the bears, I suppose, on the banks had been expecting. So what we have seen in terms of the implications is we've seen a tightening in home lending standards, right? But to be fair, that tightening actually started in 2015, and I'll talk a little more about that later. But the tightening of lending standards actually started in 2015, and it's been exacerbated by the Royal Commission. So some of you might have already experienced this. If you apply for a home loan today, the banks are asking for more documentation to verify your expenses and your income, and they might be being a little bit tighter on the limit that they're happy to approve for you. So that is one implication we've seen, and it has slowed down credit growth a little bit, but we'll come to that in a couple of slides. On the SME lending front, no real issue. In terms of vertical integration, there were fears that the banks would be forced to break up and separate the non-core banking activities from core banking activities. So basically divest all of their wealth management and anything else that they do, and just be forced on banks. But the Royal Commission or no other regulatory body has actually come to the recommendation that vertical integration should be stopped. So vertical integration is still well and alive, and it's still very much allowed. One of the more significant recommendations that actually came out of the Royal Commission related to the way mortgage brokers should be remunerated. And if that recommendation was adopted, it would have actually resulted in some wholesale changes to the landscape of home lending and the distribution of home lending. But what's important to know is that that recommendation has actually not been taken up by the government. So as far as broker remuneration and mortgage broker operations go, it's pretty much status quo, at least for the next 3 years, and most likely even beyond that. The issue, the element of the Royal Commission that I do want to talk about a bit is customer redress. So what we've seen is, and this has really affected the banks outside of their core banking businesses. So when it comes to their wealth management, financial planning, insurance businesses, what we've seen is that as a result of the Royal Commission, the banks have had to focus more on areas of misconduct and remediate and redress their customers accordingly. And that's a process that's still ongoing. To be fair to the banks, this is something they started actually doing prior to the Royal Commission. Many banks in West Coast actually started pretty comprehensive remediation programs back in 2017. But as the Royal Commission rolled on, the banks kind of, they intensified their remediation programs. What we've seen to date, so if I take a look at remediation paid out from FY17 to now, not just paid out, but also provisions that have been recognised on the balance sheets, we're amounting to now close to $4 billion, and there will be more to come. And the bulk of that $4 billion has really related to insurance and financial planning, and out of those two, it's really related to financial planning, where areas of fees being charged for no service or inappropriate advice being provided, and the banks are having to now redress customers for that. My view is that there will be more remediation provisions to come from each of the major banks, but I don't think the magnitude will be such that it will warrant any fresh capital raisings or even dividend cuts on its own. So I think when we're thinking about the dividend outlook, yep, there are more remediation hits to come, but I don't think it will result in normal dividend cuts by itself or materially dent the capital positions. So just to round off the discussion on credit growth, so you've already heard me say that the banks have been tightening their lending standards. The tightening really kicked in 2015, courtesy of APRA, the prudential regulator. The prudential regulator actually at the time, in many ways, forced the banks to tighten their lending standards. And what that's resulted in is, what I've shown here is, this chart over here is really showing home loan growth for the system as a whole. So this includes banks and non-banks, anyone that's a home lender. Going back to 1995, and you might be interested to know that prior to the GFC, system home loan growth was almost always double digit. It was always 10% plus. But since then, it's been falling. And what we've seen since 2015 is, we started seeing a bit of a recovery from late 2012, where home loan growth started picking up. and that's the solid blue line that I'm looking at. But since 2015, as you can see, it's started to trend down again. And again, the reason for that is the banks have really been tightening their lending standards over that period. And then you can see that there's a particularly notable dip down from late 2017, and that's courtesy of the Royal Commission. So as the Royal Commission started to progress, the banks became even more tighter with their lending standards. In particular, what's happened in the last 18 months is the banks have become very, very tight with expense verification. And they're asking for more and more documentation to verify expenses, and that's naturally resulted in credit growth dropping off. Now, why am I talking about credit growth? Because credit growth obviously is one of the key drivers of revenue growth for the banks, right? So when credit growth slows, you can expect their revenue growth to start slowing. And that has happened. We have seen a slowdown in revenue growth. So at the moment, over the last 12 months, we've had system home loan growth at about 3.7%. If you go back 12 months, it was running closer to 6% per annum, right? So there's been a considerable slowdown in that. But the good news is that the outlook for system home loan growth, from my perspective, in my view, is improving. And it's improving for a number of reasons, and I've got those points there on the slide. They're actually all the reasons why the outlook's improving. But one of the main points to note is that I mentioned that APRA started clamping down on lending standards back in 2015. They're now starting to reverse some of that and starting to loosen some of the standards. And some of the tightening that they imposed in 2015 has now been abolished as of the start of this calendar year, and in some cases as of the start of this month. And that should result in credit starting to flow more freely again. I mean, one of the limits they had in place is they had limits in place to the extent on the amount of investor lending growth that the banks could do, investor home loan growth, and on the amount of interest-only home lending that the banks could do. But those two limits on investor lending and interest-only lending have now been removed as of the start of this calendar year, and we're already starting to see credit flow more freely. And what we've seen earlier this month is another significant restriction that was in place in terms of serviceability assessments. That's been lifted, and that should now result in credit flowing more freely as well. And at the same time, what we're seeing is take heart from the fact that we're seeing macroeconomic stimulus initiatives being announced on multiple fronts. So we've seen it on the fiscal front with tax cuts being announced, and that tax relief should assist households and increase their propensity to borrow. And then that's one of the ideas behind it. And at the same time, the coalition government on the fiscal front, they've announced the first home loan deposit scheme that will kick in next calendar year. The first home loan deposit scheme will basically allow first home buyers to take out home loans with a loan to valuation ratio up to 95% without needing to purchase lender's mortgage insurance. At the moment, if you are taking out a home loan that has got an LVR more than 80%, you need to pay the lender's mortgage insurance premium. But what the government will do for first home buyers is they'll basically be guaranteeing the credit risk of those loans and not requiring LMI to be purchased. So that's something that should be credit positive as well. The other thing we've seen, and this has been well flagged by the media, obviously, the RBA has been cutting interest rates. We've seen 2 cuts over the last couple of months, and that should also assist the loan growth outlook. So at the moment, like I said, for the last 12 months, system home loan growth has been about 3.7%. If I take a look at it in the last 6 months annualised, it's been about 3%, so it's starting to look quite abysmal. But I've got it now, in my forecast, I'm allowing for that to pick up to 4% over the next 12 months, and 4.5% over 2021. Still on credit growth, but thinking about business lending growth. This has been a real positive of late. Business lending growth, hopefully you can see this chart, but business lending growth is shown by the grey line, and home loan growth is the blue line. What you can see just in the last few months is business loan growth is now running ahead of home loan growth, and that hasn't happened for quite some time. So we've seen business loan growth of about 4.5% over the last 12 months. And that is something that's exciting, because it just goes to show that there is still enough business confidence there to perhaps not fall into a recession as an economy. And at the same time, that improving business loan growth is supporting the revenue growth of the banks. Someone like NAB stands to benefit most from that, because NAB is the leading bank in terms of SME lending market share. So as that business lending growth picks up, NAB's probably a bigger beneficiary than some of the other banks. So we've talked about credit growth, which is one of the key drivers of revenue of the banks. The other key driver is the margin that the banks make on those loans. So when the margins are contracting, obviously that's not positive, that's negative for revenue growth. When the margins are expanding, that's obviously a positive for revenue growth. My view is that over the next 2 to 3 years, the banks will, broadly speaking, keep their margins stable. Now, there will be other analysts on the street that might try to counter me on this, and they'll say, no, if you get into a lower interest rate environment, the banks will be making lower margins. And that's true, but that's only true with all else constant, right? That would only be true if the banks aren't repricing their loan books and their deposit books actively. Whereas my view is the banks will reprice their loan and deposit books quite actively to keep their margins stable. We will get to a point where the banks will not be able to pass on maybe 50 or 60% of any RBA interest rate cut to home loan borrowers without taking a material hit to their margins. But when we get to that point, and I don't think that point is too far away, when we get to that point, I don't expect the RBA just to be cutting rates by itself. I expect the RBA to accompany those rate cuts with some unconventional monetary policy tools. And that's where I think the quantitative easing might actually commence domestically. So what the RBA will need to do is they will need to provide, so from the RBA's perspective, I don't think the RBA actually wants to see bank margins and bank ROEs contract. Because if bank margins contract and if bank ROEs contract, that means the banks have got less ability to lend into the economy. The higher the ROE, the healthier the bank, the more loan growth it can support. And that's what the RBA wants to see at this point in the economic cycle. We actually want to see credit growth pick up. I mean, if we go back and look at what home loan growth has been doing, actually it's been trending down since 2015, and that has been hurting our GDP growth. And that's something the RBA ideally wants to reverse. They want to see that credit growth pick up again. But if they want that credit growth to pick up, they want the banks to be able to maintain their ROEs. To maintain their ROEs, they do need to be able to maintain their margins. So then you can say, well, the RBA's got a dilemma. They don't want bank margins to be hit, but we need lower rates to reflect the economy. And this is where I think the quantitative easing kicks in. So at some point, it's possible what the RBA needs to do is cut the official cash rate. They know the banks can't fully pass it on to home loan borrowers without taking a hit to their margins. So they need to give the banks some sort of mechanism to be able to pass on the rate cuts in full, but keep their margins stable. So what's that mechanism? One option, there's a few options here, but one option, and this is my base case at this point, I think if we get to that point, I think what the RBA will do is something akin to what the Bank of England did in the aftermath of the Brexit referendum. And that will involve printing money basically, and I'm speaking in simple terms, but printing money and lending it to the banks at a 4-year term at the cash rate. So they'll give banks access to 4-year money at maybe 25 or 50 bips per annum. And so that will allow the banks to fully pass on the rate cut to the home loan borrowers and offset the margin hit with cheap funding. So that this funding tailwind come through and allows them to keep their margins stable. And if that all works to plan, that should result in improving credit growth and banks continuing to lend and in fact increasing their lending into the economy without compromising on their margins or their return on equity. And in that situation, obviously, if we do get to that point, you'll have the RBA expanding its balance sheet and doing, basically, this would be a form of quantitative easing. I mean, conventional quantitative easing involves printing money. The central bank prints money and buys up government bonds. In this case, they won't be buying up government bonds, they'll basically be buying bank debt. it is a form of quantitative easing. And that should drive those risk-free rates we spoke about earlier even lower. And if bank dividend yields are sustained, it creates more valuation upside for the banks. So they're basically reflating asset prices. Just keeping an eye on the time here as well. I'll try to restrict this to another 10 minutes and then open it up to Q&A. Costs, yeah, this is something that I do want to talk about a bit. So this is an exciting part of the bank thematic at this point in time. Historically, what the banks have focused on in terms of cost is what they call positive jaws. And what positive jaws means is they always try to keep their expense growth below their revenue growth. But when they've had a target like that historically, expense growth, they've always intended for expense growth to be positive, but lower than revenue growth. That's now changed. The banks aren't really looking to grow their cost base at all. They're looking to keep it flat to declining. And in fact, all four major banks now have got a stated target of reducing their cost base in absolute terms over the medium term. And this is something that's new to the banking landscape. Now, there is still enough, because it's quite new to the banking landscape and a lot of analysts and investors haven't seen this from the banks before, they're not quite believing the targets of the banks yet. They're kind of thinking, well, okay, you're aspiring to reduce your cost base, but we think you can't do it, and we think you're talking a lot of fluff in terms of how you will do it. But I actually believe it, and I think they will do it. And I don't think they've got any other option, because we are now in an age of increased digitisation, increased automation, and we are seeing a lot of that digitisation and automation in the financial services space. You would have heard of the term fintech, right? Fintech is all about basically automating and digitising the existing way of doing business in financial services. Right? It's just writing the code for certain things and automating them. That's what it is in very simple terms. And that's what the banks are now starting to compete against in some regards. We're seeing these small fintech players pop up, and they're offering very niche services to consumers and trying to chip away at bank market shares in certain areas. But the banks, they're not closing their eyes to this, and they're not trying to be dinosaurs about this. They are trying to keep with the times. They understand that digitisation and automation is the way forward. And so what the banks have actually done in many cases is they've set up their own venture capital funds. And they've even taken stakes in some of these fintechs that are turning out to be quite successful. And in some cases, they've bought the fintechs outright. So Westpac started off with a $50 million venture capital fund. They've now got a $150 million fund. They've got, Westpac has got stakes in things like Zip Money, home loans. Even in the Bitcoin space, in the crypto space, they've got a stake in Coinbase, and they've got about a dozen other fintechs that they've got stakes in or own outright. And this is true for the other banks as well. So what the banks are now doing is, with each of the banks, they've got an annual investment spend of somewhere between $1 billion and $1.5 billion. That's what they're spending in terms of CapEx and OpEx per annum on the investment side of things. And that investment is going into digitisation, automation, but also, upgrading and setting up new regulatory and compliance systems. What we've seen over the last 18 months is, because of the Royal Commission and all the regulatory scrutiny that the banks have been attracting, they've been spending a little more of that spend on the regulatory and compliance side. But what will happen over time, and this will start happening very quickly, in fact I expect it will start happening in about 12 months' time, they will maintain their annual investment spend at somewhere between $1 billion and $1.5 billion. But the allocation of that will start to switch towards digitisation and automation. So I don't think that banks need to spend any more overall than what they are at the moment. What they can afford to do is keep the investment spend flat where it is, but spend more of it on digitisation and automation, and that's what will happen. And as they do that, what they'll do is they'll obviously become more efficient enterprises. They'll offer a better customer service proposition, and they'll be able to reduce their headcount. And not just their headcount, I think they'll be able to continue to reduce their branch numbers. They'll be able to reduce even other things like the amount of ATM machines they've got out there. But the headcount will be a big one. I mean, if you think about the cost structure of a major bank, speaking generally, headcount is about 50% of the overall cost. Now, my view is that over the next 10 years, each major bank should be able to very easily be able to strip out 20% of their cost base over a period of 10 years. But more realistically, I think they can strip out 20% of their cost base over the next 5 years, right? And they're actually already starting to do that. So even this year, Westpac is, even with all the industry challenges that they've been facing over the last 12 to 18 months, Westpac in the current year is aiming to reduce their underlying cost base by 1%. ANZ has got a stated target of reducing its cost base from $8.6 billion currently, that's $8.6 billion per annum, that's what they're spending, to $8 billion by 2022. Similarly, CBA has got a target on absolute cost reduction, and as does NAB. So this will be an area which, this is a theme that I think isn't really being reflected in current share prices because there still aren't enough believers of this cost out story. But I actually don't think the banks have got an option, like I said earlier. I mean, they're dealing with the fintech era now, and there's no option but to start digitising and automating more and more and more. And we'll get to a point where these banks really start looking like IT companies that are offering banking and financial services products. In fact, even going back, 10 years, I remember when Ralph Norris was the CEO of CBA, in one of the meetings I had with him, he at the time was describing CBA as an IT company that's offering banking services. But that theme will become more and more profound in coming years. And it's quite important because every 1% reduction that the banks can achieve in their cost base results in 1% profit upside. And this is part of the story of how the banks can do mid-single digit underlying EPS growth. So with every 1% growth in revenue, that generally translates to about 2% profit growth. And every 1% cost reduction is about 1% profit growth with all else constant. So you can have a bank that's only doing 3% revenue growth, and if they're doing even no cost reduction, they should be able to do 5 or 6% EPS growth or earnings growth, profit growth. And you can have a bank that's maybe doing 2% revenue growth, 1% cost reduction. That should be enough to also get them to 5% profit growth. So that's why I think mid-single digit earnings growth and profit growth I think is very conceivable for the banks on an underlying basis over the medium term. I'm stressing underlying because what we'll continue to see, like I said earlier, what we'll continue to see over the next 12 months is more remediation charges, and they will hit the profits at a headline level. But we need to look through that because those remediation charges won't be recurring. They are very much one-offs. I think in 6 months or 12 months' time, they'll pretty much be largely out of the way. In fact, I think most of the banks are now over the hump in terms of their remediation programs. So that's definitely a very exciting part of being a banking investor right now. Just thinking about what the banks can do in terms of technology and automation and digitalisation and really what they can turn themselves into. I'll touch on asset quality. Like I said earlier, I mean the banks are naturally in the business of taking credit risk. This is what they do. They forward loans, and they take the risk that those loans won't be repaid. What I've shown here on this chart is for each line is each major bank, it shows their annual bad debt charges as a percentage of their loan book. And what you can see here is, the latter part of the lines, they're just forecast, but this is where we're pretty much sitting at the moment. And what you can see is that putting it in the context of the entire cycle, we're at a pretty low point in the cycle in terms of bad debt charges. So you can make the case that asset quality right now, or credit quality, is about as good as it gets, right? And it's actually been the case for some time now. I mean, you can go back to, with the exception of some anomalies, since about 2015, it's been at these cyclically low levels. And since then, pretty much all us analysts and investors, including myself, we've been forecasting a modest deterioration because we keep thinking, well, you can't get, your credit losses can't get any lower than what they are. So surely they'll tick up, and we build a bit of conservatism into our forecasts and our valuation, and we've been allowing for a modest deterioration in credit quality. But since 2015, it's actually continue to trend even lower. So it continues to get even better. And we're still at the point where it's so low that most analysts will be saying, you know, it's only natural for credit losses to pick up from this point. Well, and that's what I've got. I mean, you can see in my forecast, I've got them picking up, so I've got modest deterioration coming through in terms of those credit losses. But what we've got now is what we've seen in the last 3 months is we're seeing all these macroeconomic stimulus initiatives being announced. I've talked about earlier about the fiscal stimulus that's been announced, the monetary stimulus, and the loosening that APRA has been doing in terms of lending standards, and we call that macro-prudential loosening. And those three prongs of stimulus are actually serving to de-risk the outlook for asset quality. So it's now very possible that this deterioration that I've been seeing here might get pushed out for 2 or 3 years, right? But it's always hard to know. It's always hard to know with asset quality how it will exactly play out. But you know, if these stimulus initiatives go to plan, it should result in improving consumer sentiment, improving business confidence, improving credit growth, and therefore improving GDP growth. And we manage to reflate the economy to some extent. And even if we don't, even if things keep chugging along, at least it's averting a recession. And that's one of the reasons. I mean, if I go back 3 months, I was even more bullish on the banking sector than what I am now, because the prices were looking very cheap 3 months ago. But one of the risks I was pointing out to my outlook 3 months ago was that if the stimulus didn't come through in time, then we were staring at a recession. Because my view is that in terms of monetary policy and even fiscal policy, I think we've got enough firepower at the moment to avert a recession, but I don't think we've got enough firepower to necessarily get us out of a recession. So I think the RBA and even the government, I think they're doing the right thing by kind of being ahead of the curve. You can pick up the paper even today, and I'm sure there'll be some journo that they'll be bagging out the RBA for cutting the cash rate and maybe they're being too premature, so on and so forth. And they'll be making the case that, you know, a 25 or 50 basis point cash rate cut doesn't do much for the economy at all. I actually disagree with that. If we want to stick with this system of fiat currency, and if we want to stick with the way the modern economy is working at the moment, so philosophically, if we're agreeing on this, and if we disagree, then that becomes a philosophical issue. But with the paradigm that we're working in, I think the RBA is doing the right thing. Okay, so so what that's serving to do is de-risk the earnings outlook and the credit risk outlook for the banks, and that's posing some upside risk to my earnings forecast as well. And what all of this is basically also serving to do is it's making the dividend yields look more sustainable, because asset quality is now starting to look a little better than what it was pre-stimulus, because the outlook for credit growth and revenue growth is improving, and because of my view that the banks can keep their margins stable. And if we get to the point where the interest rates get so low that they're hurting margins, I think the RBA will provide quantitative easing relief. All these factors combined mean that I think the dividend yields that are on offer at the moment are largely sustainable, right? This slide is basically talking about the capital position of the banks. Without boring you with all the detail, and I'm mindful of the time here, the banks are generally in pretty comfortable capital position. So in terms of where the prudential regulator wants the banks to be by 1st of January 2020, they're looking quite comfortable. In fact, banks like ANZ, and I mean ANZ's already got surplus capital. I've got them. You know, I'm forecasting ANZ to return $3 billion to shareholders over the next 3 years, and they can even return more beyond that time frame. CBA might be in a position to return about $5 billion to shareholders by the end of next year. Westpac needs to build up its capital position a tad more, and they can just do that just by running a discounted dividend reinvestment plan with their next dividend, and they should be okay. And NAB has already rebased its dividend 6 months ago, and they've raised a bit of capital as well through a hybrid conversion and a discounted and underwritten dividend reinvestment plan. So NAB's looking okay in terms of capital as well. So I don't think the capital positions are placing any strains on dividends. There is one thing I'm going to point out. I said right on the first slide that Westpac is my preferred bank, and it is. It's actually hands down my preferred major bank for too many reasons. But what I will point out with Westpac is probably most at risk of cutting its dividend in the next 6 or 12 months, right? And why is that the case despite everything I've said? So my view is I actually don't think Westpac needs to cut, right? So when I do the modelling on Westpac, I think all they need to do is discount their next dividend reinvestment plan, and their capital position in dividend is looking fine. But unfortunately, the way the institutional investor landscape is working in Sydney and Melbourne at the moment is some of these fund managers, or enough of these fund managers, want some of these banks to cut their dividend just because they think they're of the view these dividends are not sustainable. Even though I completely disagree with that, because you can model it all out and it all looks very sustainable. But in some cases, what some of these fund managers are doing is they're looking at the dividend payout ratios, which is the dividend being paid out as a percentage of earnings at a headline level. And that looks quite inflated. So if you take a look at the earnings for the last 12 or 18 months of the banks, they've been hit because of remediation, right? They've been remediating customers. In some cases, they've been restructuring as well, so the banks have been taking restructuring provisions, and that's been eating into their headline earnings. So when you take a look at the dividends they're paying out as a percentage of headline earnings, it can look unsustainable. In some cases, they're paying out 80, 90%, even 100% of the earnings. And some fund managers look at that and they say, well, you can't pay out 100% of your earnings and expect to continue to grow your loan book. But what I think the point they're missing is they shouldn't be looking at headline earnings. You really need to look at what underlying earnings are doing, because when we're thinking about dividends, it's not just for 1 year, it's a dividend policy for the foreseeable future. And that should be, you really need to look at, you don't get thrown off by one-off losses or one-offs. You have to look through that and look at, well, what sort of underlying capital generation is this bank doing, and what sort of dividend payout ratio can it sustain? And in terms of that, I think Westpac can keep its nominal dividend flat where it is. But for the reasons I just mentioned, I feel that the board of Westpac is being pressured by some of these fund managers to cut their dividend. Now, if Westpac does cut its dividend in the next 6 months, what does that mean? I'm actually still comfortable having Westpac as my preferred manager. Why? Because if these fund managers force Westpac's board to cut, and the board does cut, then these same fund managers will be buying up the stock, right? And that's basically, I think, what they'll be saying to Westpac. They'll be saying, look, we're not interested in taking a position in Westpac right now because we think your dividend looks unsustainable. So if Westpac does cut, I think that would actually be share price positive. And we've seen that happen with NAB. I mean, NAB actually cut at their last half-year result, and the stock has actually outperformed since they cut their dividend. Even though I think NAB's cut was due to some serious company-specific challenges. But some of these fund managers are just happy to buy once a dividend's cut, and that would explain NAB's outperformance since its dividend was cut. So even if Westpac does cut, it's still my number one bank. Yep, your yield might drop from 6.9% to, let's say, maybe 6% or 6.2, 6.3%. It's still a very good, healthy, fully franked yield. And at the same time, I think there will be share price upside for Westpac out of it. I might just pause there or take a break there and open it up to Q&A. See if there's any questions. I am mindful of the time here. Are there any questions on anything I've said so far? Yeah.
I've got a comment and a question.
Yeah.
Talking about cutting costs, having worked for large corporates all my life, this shrink to grow thing doesn't work. And also, large companies tend to be too democratic, and they say you've got to cut 10%, and they end up cutting muscle with that. So what's to give us confidence that the banks won't do exactly the same, where they don't display agility in any fashion?
Yeah. So you're right. You can say logically it's hard to shrink to grow. But what the banks need to be doing right now, if the banks want to grow, they actually need better technology, better systems, better banking apps, a better end-to-end digital customer service proposition. Right? I'll give you an example. Westpac wants to digitise its mortgage origination process end-to-end by the end of next year. Right? Why do they need to do that? They need to do that to grow. They need to streamline their offering, make it quicker. They want to reduce the conditional time to a home loan approval. Banks want to make it quicker and easier for you to be able to open a transaction banking account. And some of the fintech players and even some of the banks, they're now allowing you to open up a transaction banking account, even a savings deposit account online, purely online, in under 4 minutes. And the banks globally are now starting to compete on this time. There's a bank in Russia claiming to be able to do it in under 2 minutes. Set up your whole banking account online in under 2 minutes, and apparently that's the quickest out there at the moment. So what the banks need to do to grow right now is digitise, automate, because that's what will offer a better customer service proposition. But the way it works is, luckily for the banks, the more they digitise and automate, the less people intensive the businesses become, the less paper intensive it becomes, and naturally costs just come out. The reality is we've got these multi-layered bureaucratic 4 major banks right now that are inefficient in many regards, and that inefficiency is actually an impediment to growth. So I don't think they'll be shrinking to grow. I think they'll be becoming more efficient to grow.
Sorry. Was it the regulatory environment's pretty tough here at the moment, as well as the domestic lending market? Can you see banks looking offshore to fund earnings growth?
As in going back to doing offshore operations?
Well, I guess we know the home side lending debacle for NAB and Clydesdale and ANZ into Southeast Asia.
Yes.
But I guess when you're talking about technology, it has a global application.
Yes.
Is there the opportunities for them to look outside of our borders?
Yeah, that's a very good question. And so you're right. I mean, the regulatory environment has become tighter over here. It's become a lower growth banking environment. It's still a relatively high return on equity environment for banks, Australia and New Zealand, but the growth opportunities aren't that exciting. And there's no doubt that if you look at parts of Asia, parts of the emerging markets, there's far more exciting growth opportunities. And what's made the situation worse for the majors right now is that NAB's retreated from offshore. They've pulled out of the US, they've pulled out of the UK and Ireland. ANZ's not completely pulling out of Asia, but they've reduced their presence in Asia quite substantially. And so what that means is that all 4 major banks are now domestically focused and competing more with each other domestically. So there is more competition. We're already starting to do that. I mean, we can already see that in some segments. If you take a look at owner-occupier principal and interest lending, that's a very competitive space right now, and you can get some very big discounts off standard variable rates. I mean, some even major banks are happy to knock 160 basis points off your standard variable rate on a home loan. And that makes growth even more challenging. The fact that all 4 majors are now competing domestically and just focused on the domestic market makes it more challenging. I think it is inevitable that at some point one of these guys will stick their neck out again and do a foray offshore. It's just a cycle that we see. I mean, even with ANZ back in the day, they used to own Grenlays in the Indian subcontinent. They pulled out of that. The timing was terrible. But then, a few years back under Mike Smith, they went back into Southeast Asia. We've seen NAB make a couple of forays into the US and pull out. They've been into the UK and Ireland and then pulled out. I think it's inevitable that they go back. I mean, so in terms of the banks that have got a notable presence offshore at the moment, outside of New Zealand, obviously ANZ's still in Asia, and they will look to grow that in profitable parts of Asian banking. And you've got CBA with some sort of presence in Indonesia. What CBA is actually notably doing in Indonesia is they're testing a lot of their digital banking systems and software in Indonesia. That's where they've been really rolling it out. They haven't been rolling it out so much here. One of the reasons I think, and I'm going on a tangent a bit, but I will round up on the question. One of the reasons I think the banks aren't talking too much about a full service digital banking offering domestically is because if they start talking about it, the stakeholder that will become most agitated or I suppose anxious by that would be their own employees. Because the moment they start talking about full service digital banking, if you're an employee of one of these banks, you'll be thinking, well, your job's on the line. And that's why I think they don't talk about it so much here. But I think Indonesia's been testing grounds for some of these digital software applications for CBA. It's possible if that starts taking off CBA with the presence they already have in Indonesia, maybe they look to increase that presence and possibly get into some neighbouring countries. Now, in terms of the neighbouring countries, I mean, Malaysia's a pretty saturated banking environment. Singapore, there isn't too much growth there. I mean, the three big Singaporean banks themselves are looking offshore for growth. But it's possible CBA looks to become bigger in Indonesia at some point, and maybe some of the other neighbouring countries there. But I think none of the banks right now have got any plans to go back offshore, but I think it's inevitable that in search of growth, sooner or later that they will go there. In terms of my forecast, over the next 3 years, I've got no one kind of doing that.